Thank you, Lori, and the Program for Financial Studies. Nice to see some familiar faces. So today's talk is about increasing lending in a crisis. It's taken from some recent work that I've done with two accounting professors here in the business school, Sharon Katz and Gil Sadka. So why is this an important issue? Why do we care about increasing lending? Well, you may have heard, or you should have heard, just reading the news about many are advocating increased lending, or saw increased lending, or still see increased lending as a goal, which is supposedly going to help things out a little bit and stimulate the economy. This is just one quote from President Obama: "Time for banks to boost lending. Given the difficulty business people are having as lending has declined, and given the exceptional assistance banks received, we expect them to explore every responsible way to help get our economy moving again." Implicit in this is that there is some responsibility for banks to lend to firms, and this is seen to be something that will help the economy. Okay? But when we think about this and take a step back, we ask the question, well, why are banks not lending to firms, or why were banks not lending to firms in the first place? Right? So it's possible that there is some sort of restriction in the market, and maybe an inefficient restriction, and intervention is needed. But the first thing to ask is, well, banks, their profession is to lend. That's their business. And if they're not lending, maybe the lending was not a great idea, right? Especially in more recent times where we see many large firms and banks that have cash reserves and are not lending them out. Maybe lending is just not a good idea and a losing proposition. Now, I think it's important to differentiate between discussions about increased lending as an indicator. That's come up recently, where you may look at the economy and say, we see more lending activity going on. This is an indication, perhaps, that things are getting better, but this is a statement about what's going on in the market by the market participants, and not a statement about how market participants should change their behavior in order to do something different, in this case, increased lending. Okay, so the questions that we ask are fairly straightforward. The first one is, what happens when constrained firms are offered more capital, are given more debt capacity? I stress more here because we're talking about a situation in which some sort of intervention causes causes banks to lend more than they would otherwise. So I'll show you that, yes, firms that are constrained do want to borrow more. So firms will take this capital. But then the question is, what do they do with this capital? Is this a good idea or a bad idea? What do they do with it? And I'll show you that in the work that we've done, we find that there is no evidence they increase their investments or even their cash buffers. We do see some evidence that retained earnings decrease, both because of a decrease in earnings and some dividend distributions. But again, there's nothing in terms of an increase in R&D and capital expenditures, hiring, and things like this. So no evidence of these things that are implicitly assumed will result from increased lending. There's some evidence that financial distress or severe financial distress in the form of liquidations is delayed, and that may be a good thing, may or may not be a good thing, right? But it's a different thing than what many are thinking about when they think about stimulating or encouraging more lending in the economy. Okay? So for the rest of this talk, I'll sort of show you how we get about answering this question and show you why it's a hard question to answer, and why you may come up with different ideas about what the answer is if your research design is not very careful. Okay? So there are two main challenges in answering this question. The first challenge is the challenge that virtually all empirical work in economics faces. It's the challenge of looking for causality, of making causal statements. Right? A general research design will look at the past in some way. We'll look at the past. We'll try to establish a causal link between some activity and some policy goal. Right? So you'd want to look in the past and find a link between lending and, say, investment. It's important for this to be a causal link, because then we want to take this causal link and not just look at it as a historical observation, but rather extrapolate from it for the policy goals we are considering, right? So in this case, we'd want to find a causal link between increasing lending, between an intervention that increases lending and some sort of stimulated investment or stimulated economic activity. And then we can go and say, hey, maybe we should be focusing our efforts on pushing banks to lend more, right? So this is the first challenge. This challenge takes the specific form of us worrying about, well, if we go out in the market and compare firms that are borrowing more to firms that are borrowing less, there may be a reason, again, that some firms were given more capital or some firms were allowed to borrow more. This reason may just be that better firms are borrowing more than worse firms. And the reason that firms are not borrowing as much is because banks who are supposed to be specialists at providing capital just don't see this as a good idea. Okay? So this is the first challenge, right? What we want in all these settings, right? Ideally, we'd want something like an experiment, right? Something like a medical experiment where we'd put a bunch of firms in the same room or a huge room. We'd have lots of firms that are all the same, that would behave, that would trend in the same way, and randomly let some borrow more than others and compare outcomes. Of course, we can't do this. So as economists, we look for what is called a natural experiment, a situation where policies generated a reality that, with the use of some econometrics, simulates this kind of random experiment. Again, a scenario from which we can make causal statements. Okay? Now, and I'll show you how we find a natural experiment in this case and what the findings are. The second point is that, again, what you're thinking about is establishing a causal link in the past in order to extrapolate for the future. What we want to make sure is that we're extrapolating to a similar future. Okay, so in this case, we'd like to see similar economic climates, right? You might imagine that stimulating lending in times of boom is very different from stimulating lending in times of crisis or in times where there just aren't as many good investments out there. Okay, so these are the two challenges that we confront. How do we do this in this case? We find and analyze, and herein is the partnership between the accounting professors and myself. We analyze what is seen to be an exogenous we think of as exogenous, endogenous, again, are words that we use all the time. Exogenous in this case means it is something that is unrelated to the economic activity that we're thinking about. We find an exogenous shock to the debt capacity of firms that are constrained. This shock comes from an accounting change that affected some firms but not others. The motivation for this change was accounting type motivations, right? Increasing transparency, increasing the conformity of the change to international standards, but nothing to do with the economic activity of the firms, right? And I'll explain this in a minute. We look at this shock. It happened during the financial crisis, and that's how we make this causal link from which we will extrapolate. Okay, so what is this shock? What is this accounting change? And time is short, so I'll be very brief about this. Basically, imagine that I have a firm, and my firm goes out and buys Professor Hodrick's firm. Okay? But I decide not to buy 100% of her firm, but rather buy a majority stake. Say I buy 80% of her firm. All right? The question is, what happens on the balance sheet? On my balance sheet, where does the 20% of Professor Hodrick's firm that I do not own go on my balance sheet? And this is where the change took place. All right, so I'll show you this on the balance sheet. Beginning in 2009, the rules changed. So this is called minority interest. The 20% of Professor Hodrick's firm that I don't own was called minority interest. It'll later be called non-controlling interest. Right? Before, it was on my balance sheet, but it was in a mezzanine section, generally, between the liabilities and equity. After the change in the current treatment, it's now called non-controlling interest, and it is moved into the equity section of my balance sheet. All right? So if we look at an example firm, this is a balance sheet. Don't try to read everything that's on the slide, right? But if you look at the boxed region, minority interest is here. Just look at the location in between liabilities and equity. Okay, you can see the numbers basically, right? It's somewhere in the 3,000s, and the total size of equity, again, is 3,600 or 3,100 in 2007. Right? After the change, This is the statement for the same year, for 2008, in the statement filed in 2009. Minority interest is now termed non-controlling interest, and it moves into the equity section of the balance sheet. Now, why does this matter? How does this help us to answer the question that we're answering? Well, the reason that this helps us is that the total size of equity for the AES Corporation grows now. It grows precisely, in our example, by the 20% of Professor Hodrick's firm that I didn't own, right? So if this was my company, my equity now increases by the size of the subsidiaries that I did not own. How does this generate now? This has a big effect, and how does it affect what I'm talking about, the shock? Once I explain this, the rest is completely straightforward, right? Firms that borrow enter into debt contracts. These debt contracts impose restrictions on the activity of firms. Some of these restrictions are stated in terms of firm equity. So now imagine that my firm was borrowing, and some of my debt contracts had covenants stipulated in terms of equity. An example of such a covenant is a debt-to-equity requirement, where my loan is conditional on my debt-to-equity ratio not crossing a particular threshold, right? That I maintain a level of debt which is not too crazy. This is a reasonable and fairly common covenant. There are other covenants like this. All right? So I am now constrained in my borrowing. Because I borrowed before, I'm constrained by this debt-to-equity covenant, right, as an example, or a net worth covenant, or other covenants of this nature. Okay? So now how does this accounting shock help me? Well, again, imagine that I'm constrained by my debt-to-equity covenant. I want to borrow more, but I can't because I have a restriction in terms of debt-to-equity. Well, what happens as a response, as a result of this accounting change? In the case of this corporation, equity we saw increased. What did that do to debt-to-equity? Was that a big deal? Here it was a huge deal, right? So for 2008, the 2008 statement, this is the same company, the same year, solely as a result of the accounting change, the debt-to-equity ratio fell from about 4.93 to 2.57. What does this mean? This means that, wow, now I have much more slack in my debt capacity because I'm no longer potentially much less constrained by my debt-to-equity ratio that I promised would remain in a certain threshold before. Okay? So now we use this to create a treatment group and control groups. And how are we going to establish a causal link? We'll say, well, hey, this treatment is a treatment that resulted from an accounting motivations and nothing to do with the economic activity. Let's look at how our treatment group and control groups trended before and trended after this accounting change. Let's see that we have a good experiment. And then again, let's look at those two questions that we're trying to answer. Do firms take advantage of this and borrow more? And then what do they do with this money? Okay? So this was a big change, right? So there's discussions about this, that it did matter. There's a whole big discussion in general about how much does accounting matter for economic activity. In this case, there is prior work showing that there was a stock market reaction or different stock market reactions to various phases of the discussion of this accounting standard. In particular, notice that there's some evidence that there was a stock market reaction to the passing of the rule, and this reaction was positive and stronger for firms that had subsidiaries, that had minority interest of the sort that I described. So how do we implement this? Okay, and this is the last piece of the way we do this type of research. Step one, we isolate the treatment and control groups. What's our treatment group going to be? Well, it's going to be firms like the one I described here that have subsidiaries and have minority interest or non-controlling interest. So they could benefit from the change, so the change was relevant. But we also want these guys to be constrained precisely in a way that where the accounting treatment would have an impact, right? So we want our treatment group is going to be firms that were constrained, meaning they were close to violating covenants of the sort that were affected by this accounting change. So a classic treatment firm would be a firm that has minority interest, a lot of minority interest because it has a bunch of subsidiaries that it doesn't own in its entirety, but has borrowed and is close to violating covenants stated in terms of equity. Why is this a great treatment firm? Because then after the accounting change, it'll receive a lot of slack in these covenants. It'll receive a lot of slack in its debt capacity, and then we can go ahead and say, well, wow, this is a situation where these firms got slack in their debt capacity because of something that had nothing to do with how they were behaving economically, and then go out and trace, well, what happens to try to establish this causal link. We use various control groups. I'm not going to go into all the details of the empirical methodology, but we can control for firms that were similar because they had subsidiaries. So you may imagine that firms with subsidiaries are different. We can control for those kind of firms. And we can also control for firms that were constrained by similar covenants but just didn't have subsidiaries, right? That's the first group. The second group is firms that had subsidiaries but weren't constrained, right? So we can control for all different kinds of firms because the nice thing about this shock is it only affects a subset of firms, which gives us a lot of controls. Okay, and then so that's step one, treatment group, control group, and then from that point on it's very simple. We isolate and measure the response to treatment. This is also called difference and difference and difference. It has a bunch of different names, but don't worry about that. It's just a treatment group and a control group. In a regression framework, it's just a triple interaction between these variables. Okay, so we have the change, before and after, firms facing constraints related to covenants that were affected, so they could benefit, and that benefited from the change because they had minority interest. Okay. All right, so from this point on, I'm just going to show you what I told you happens, right? So in a picture, you can think of these as the treatment group and the control group, the blue and the red, right? You see that these lines don't have to be on top of each other. We don't care if they were at the same level, but we want to see that they were moving in pretty much the same way. And that's what it looks like here. They're moving pretty much in the same way. This is when the rule took effect. We see a big divergence in the way they were operating. The treatment firms, this is washed out. Think of this as total debt. The treatment firms increase their debt, whereas the control groups decrease their debt. Again, this is happening in quarter 4, 2008. So it makes a lot of sense that firms are having trouble borrowing. Okay? So this substantiates, right? Then this is showing it in another way. This is the whole treatment effect, right? This is what the effect was before, leading up to the enactment of the rule. Perhaps there was a little bit of anticipation. And then there's a spike in the borrowing activity of our treatment group relative to the control groups. Okay? So we can show this in a regression. I'll show you a few regression pictures. But the main point is that shock to debt capacity, treatment and control groups, the treatment groups take advantage of this shock and borrow more. Now, the second part is we go ahead and look at what they do with it. A lot of this is finding that they don't do what some people would have expected them to do, which is boost investment and so on and so forth. So, and these are regression tables. I won't spend a lot of time on them. You just look at the sign, right? They increase this is the coefficient of interest, very strong positive increase in total debt. There's some increase in dividends, and there's a big decrease in retained earnings. Think about that as payouts, right? Earnings and dividends. There's some decrease in the probability of entering liquidation or bankruptcy, but there is not increased R&D, increased investment, even increased cash, all these things that are implicitly assumed to be a result. So let's summarize and say one word about how to think about this moving forward. We find an exogenous increase in debt capacity resulting in an increase in debt. So we have an increase in lending, which came from an intervention in the market. The intervention was an intervention in the form of the accounting standard, but it was an intervention nonetheless because it impacted contracts that were written in terms of debt to equity. Okay? No increase in investments, total cash, decrease in retained earnings, delay in entering financial distress, but then again, no effect on basically all other accounting variables that you would imagine we'd look at. All right? So what are the implications of this in 30 seconds, right? This calls into question, again, this objective of convincing banks to lend more, right? So we see these rooms where policymakers meet with a bunch of big bank managers, and you imagine there's discussions about trying to get these guys to lend more, but their response could be, and based on this, they could make a good case in saying, well, if we lend more, good things aren't necessarily going to happen because we want to lend. That's what we do best. We just don't see many winning propositions in this case. Again, it is what it is, which is an extrapolation from a natural experiment that took place at the end of 2008 on a subset of firms. You can see the research, but it's something to think about when we extrapolate forward, thinking about various ways of stimulating the economy. Thank you.